Yeah, I think the primary worry here is interest rates. You know, the Fed funds rate stands at 2.25. They have come out and said they're going to tighten even more. The predictions are between another 100 to 150 basis points over the next 6 quarters. And remember, this is at the same time when they've said that they need to work down that $4 trillion balance sheet that they have. So there's sort of a double whammy in there from a tightening perspective. Now, the bank CEOs and financial institution CEOs are okay with this because this will make them more money. But anyone who's borrowing, especially mid-sized businesses and smaller businesses, could be hurt from the borrowing costs. And, of course, the housing market could be impacted by mortgage rates. So, you know, we're sitting here with a Goldilocks economy, and nobody wants this to be damaged by the increase in interest rates.
But is the Fed doing what it ought to be doing at this point in the cycle with an economy that is clicking, as you say, in kind of a Goldilocks manner, and the Fed saying it wants to get back to what are, in its view, more normalized interest rates after a period of incredible loose money?
Well, it's a good question, Tyler. You know, their target is 2% inflation, and over the past year, we've only had a little bit higher than that, 2.3%. You know, these things don't happen linearly. They just took the last interest rate increase last month, really a few weeks ago. It takes, you know, a quarter or two to work its way into the market and see what really happens from that. So the fear is that at some point, if they keep pushing on this thing, they're going to slay the goose that laid the golden egg by derailing it. The other thing is inflation itself is caused by, of course, a lot of things, including labor rates, but in this case, borrowing rates impact inflation, and so you could have this downward spiral as the interest rates go up and borrowing costs go up, creating more inflation, and then, you know, it just evolves. So this is what people are worried about. They're saying, look, it's a little bit higher than the Fed target in inflation, but this is a really good place to be.
So what are CEOs doing in response, Steve? I mean, if they're concerned that the Fed is all in on December plus 3 to 4 more hikes later, you know, in 2019, are they paring back on spending? Are they hesitant about expanding? Are they hesitant about passing on wage increases to employees? I mean, what's the response?
Yeah, I think it's a good question, Melissa, because, you know, what they always do is they look at the cost of borrowing, they look at the cost of money. Every investment from here on in has to factor in some estimate of that cost, and if it's going to be 100 basis points higher, that means the hurdles for payout are that much higher, which means it's going to be less investment. And so this is why I think that CEOs are saying, you know, look, we don't need to be quite as harsh here or quite as bearish on the interest rates. And, you know, you hear, of course, the politicians getting involved, which, of course, they always do. But the point is you don't want to derail this economy, and so, therefore, you've got to take this tightening, both on the balance sheet side and the interest rate side, into account.